Hey friends, I'm back. In the video today, I want to share 3 stocks. I own these 3 stocks in my personal portfolio. All 3 are examples why I like to buy and hold forever. The first stock, it is AbbVie. This is a stock that I started buying back in 2019 when it was on sale. The stock was on sale. It was out of favor because their Humira drug was coming off of patent. Fast forward to today, and the stock has done really well. It's up today to a new high on news that the Rinvoq patent will be extended out until 2037. As you can see on the screen in front of you right now, this is an example why I like to buy and hold forever. There's going to be a number of lessons that come out of the 3 stocks, the 3 examples today. The lesson with AbbVie is staying the course, and it's also buying value, buying a stock when it is on sale because it has problems, it has challenges, but those problems and challenges can be overcome. As you can see in front of you right now, the first tranche that I purchased was back in 2019. It was at $67.25. If you fast forward to today, the stock price hit $220.22. So on that first tranche, I'm up 227%. This is another lesson that I want to share in the video today. A lot of people believe that dividend stock investing, it's just about the cash flow. It is actually for me because I don't plan to ever sell. Like I said in the title today, these are buy and hold forever stocks for me, as is most of my portfolio. I never plan to sell. I buy and hold forever. But what's important to realize about dividend stock investing, at least the way I do it, is capital appreciation. It is possible, and it's expected with the best quality businesses in the world. The dividend growth stocks like AbbVie that I like to buy. As you can see on the screen in front of you right now, all the way at the top there again, I'm up on that first tranche, a staggering 227%. But let's go through some more metrics. I have the 2025 and 2026 EPS estimates here. The PE right now on the current share price, it's an 18.41. It's a 15.48 next year. But I want to look at a metric that is more indicative of the value that I was able to achieve based on my 2019 buy. Based on my 2019 buy at 67.25, my PE on cost is a 5.62 based on 2025 earnings estimates. Going down the screen a little bit, as you can see, the dividend per quarter is 1.64 or 656 per year. The current dividend yield, it's only about 3%. Payout ratio is pretty good at 54.8%. There's room to increase the dividend, and they have been increasing the dividend by about 6.8% per year on average. What is really important on this slide is to see the simple first tranche yield on cost, the dividend yield on cost. The way I achieve that metric is I look at my purchase price, $67.25, and I compare that to the current dividend, which is $6.56 per year when I sum up the 4 quarterly dividends, projecting them going forward. $6.56 divided by $67.25 is a staggering 9.75% dividend yield on cost. And so I'm a long-term buy and hold forever dividend investor because I can achieve superior dividend yield on cost by holding over the years. I buy it on value. I buy it when it has a good starting dividend. Also, I hang on, and I like to reinvest dividends along the way when possible. By doing this, I can really achieve a lot of cash flow, massive cash flow. And we can see here in the case of AbbVie on my first tranche, it's 9.75%, and it's not even been that many years. This was only going back to 2019. And so that's AbbVie. But I want to go on to the next stock. The next stock that I want to share with all of you today is Walmart. I want to start with a slide on Walmart that shows the stock price. As you can see on the screen in front of you right now, this is a long-term view of Walmart. So what's so interesting about Walmart, when we look at it dating back all the way to 2000, between the years of 2000 and 2016, it really didn't go anywhere. And so this is a reminder as well why I like to be a buy and hold forever investor. A lot of investors between 2000 and 2016 probably got tired of holding Walmart. They probably sold it because it wasn't appreciating, it wasn't really going anywhere in share price. But those investors who were diligent, those investors who waited, those investors that bought and hold forever, certainly they saw the rewards, because you can see on the slide in front of you right now that over time, the stock has skyrocketed. And this is the story of any business. This is why I buy and hold forever. The reason for that is businesses go through periods of plateau. They go through periods of rapid growth. They go through periods of decline. They go through periods of plateau again, and then they go through rapid growth again. Business growth is not linear. I like, for my strategy, to be a buy and hold forever investor because of this very phenomenon that we just don't know when all the business growth is going to happen, but we know when we hold the best quality businesses in the world, the growth, it's going to come in general over time. But let's keep going with Walmart. I have another slide that I want to share with all of you. So as you can see on the screen in front of you right now, this is another chart. This is a more recent chart. This is just the last 5 years. And so what you can see in front of you on this one is Walmart. Just earlier this year in 2025, it peaked in the $100 range and then it dropped. It dropped all the way to $83. And I'm sure some investors got scared. Some investors sold it. But look, right now we're back up at $102.65. And so the reason I'm showing this particular slide is that, again, it's easy to kind of get scared out of stocks. Investors don't only get scared out of stocks when they plateau, like Walmart did between 2000 and 2016, but they also get scared when stocks rapidly drop in share price. Because of these emotions that can be involved in investing, I like to set a rule of buy and hold forever for myself. When I buy and hold forever, it just takes the emotion out of the game. There's different types of emotions. There's emotions that, hey, I'm getting impatient. There's also emotions that, hey, I'm a little scared because the stock has fallen off of a cliff. Well, if I set these rules, hey, Ian, buy and hold forever, I just take that off the table. And I wasn't even tempted to sell Walmart earlier this year when it dipped, and now it's back to the former height. As you can see on the screen, though, I want to go through some more metrics and lessons that I learned from Walmart as a buy and hold forever dividend investment. So as you can see right now, it is trading at $102.51. Now, what's interesting is I started buying Walmart back in 2009, and I was so fortunate. I started buying it back at $16.61, and so I'm up 517% unrealized capital appreciation. And this again is a reminder that I'm talking here on my channel about a lot of concepts related to dividend investing. But in general, my strategy is one of dividend growth investing. And when I say dividend growth investing, I'm investing in companies that in general grow their businesses over time. And because they grow their businesses, they grow the revenue, they grow the operating income, they grow the net income, they grow the cash flow, they're able to pay higher dividends over time. So they also grow the dividend. And when dividends grow, when earnings grow, stock prices grow too. So again, I want to remind everyone at home, because there's so many doubters out there these days about dividend investing. Dividend investing, I do it for the cash flow. I never plan to sell, so the capital appreciation is nice. It feeds my ego, but it doesn't do so much for me because I don't plan to sell. But for those who really value capital appreciation, it is possible to have a lot of capital appreciation with dividend investing. You saw it with AbbVie. Now you're seeing it with Walmart. You're going to see it with the next example as well. But as you can see on the screen in front of you right now, let's talk about the analyst estimates for earnings, the consensus estimates. They're estimating in 2025, $261 a share, 2026, $294 a share. This places the forward PE at a high level. The forward PE is a 39 this year and a 34, almost a 35 next year. Now, however, I was fortunate enough to buy back in 2009 at $16.61. So my PE on cost is in the sixes this year, 5.65 next year. That is the power of long-term buy and hold forever dividend investing, but also buying at the right price. I don't buy dividend stocks just at any price. I don't buy them at the market average. In general, I like to buy companies when I see value, when I see them on sale. I'm a value shopper. This is why I oftentimes buy individual stocks instead of ETFs, although I love ETFs as well, and I try to buy them on value as well. But this is what I do. I pick and choose, and I try to buy stocks when they are on sale. But as you can see on the screen, let's keep going with Walmart. Now, Walmart, it's interesting. The current dividend yield is really low. It's less than 1%. It's 0.92%, and the payout ratio is really low, 36%, so they have room to increase it. But my simple first tranche yield on cost does not even include dividend reinvestment, is a staggering 5.66% yield. The way I achieved that yield on cost is buying and holding forever, buying at a value price, being patient, holding on, having the determination with this investment. And they're increasing the dividend on average by 5.5% per year. Market cap is a staggering $818 billion. I would say the biggest takeaway from this one is that this stock went nowhere between 2000 and 2016. But those investors who were really willing to buy and wait and kind of stay in it like I did. I bought in 2009. I stayed with it for a lot of years where it went nowhere, but I bought and hold forever. I kept accumulating shares. It paid off in the long run. And so the lesson is the best businesses in the world, they go through cycles. And it is, in my opinion, that buying and holding forever is a strategy worth considering for dividend stock investing. But I got a third one. This is a fun stock because I visited this stock not so long ago. As you can see on the screen in front of you right now, this is a screenshot of a video. This is a video I did about Caterpillar. I did this video back in February of 2024. So here we are right now in September of 2025. The title of this video, should I immediately sell this popular dividend stock? Back then it was at $312.84 a share. It had skyrocketed in share price. And I was wondering, should I sell it? Should I sell this stock and redeploy the funds elsewhere? And the reason I wasn't going to sell it, but I was entertaining this concept for the purpose of the video is sometimes a stock, it can just kind of go way up all of a sudden. Like I said, growth, it comes in spurts. There's plateaus and then there's growth. There's setbacks, then there's plateaus, there's growth again. And with Caterpillar, it had gone through rapid growth and I was like, hey, back in 2024, should I sell it? I ended up holding it, of course, and I'm glad I did. Because as you can see on the screen in front of you right now, it is even higher in share price than when I did that video. So I did that video back in February of 24. We're in September now of 25. Caterpillar right now is at 431. When I did that video, it was at 312. And so we are even higher than before. My unrealized capital appreciation on my first tranche of Caterpillar from 2013 is 401%. And so the lesson with Caterpillar is that just because a stock goes up does not mean that it cannot go up more. I know a lot of people considered selling Walmart, maybe even did sell Walmart this year because it spiked up. And then when it dropped down into the $80 range, I think they felt like, oh yeah, I did the right thing. And maybe they did, maybe they didn't. I don't know. Everyone's situation is different. I only speak about my personal journey here on YouTube for fun and entertainment. But now Walmart is back. It's back up to that $100 level. Caterpillar, it's the same kind of thing. It went up a lot, and just because it went up a lot doesn't mean it cannot go up more. This is the power of holding the best quality businesses in the world. This is why I'm a dividend growth investor. Dividend growth investing is about buying companies that are growing. They're growing the revenues, the earnings, the dividend, the stock follows as well. As you can see on the screen in front of you right now with Caterpillar, this thing is crazy. I'm up 400% now on that first tranche from 2013. But what I'm more impressed with is my yield on cost, because the stock's up, but it doesn't do anything for me. I don't sell stocks. It feeds my ego. I feel good about it. But let's look at this. Based on the earnings estimates, the forward PE now for 2025 is at 24. Next year, 26 is at a 20. But my PE on cost right now is in the 4s. That is pretty awesome. My first tranche, simple yield on cost, is 7%. And they're growing the dividend on average by 8% per year. I love this. And so again, February 2024, I was posing this hypothetical question, should I sell at $312 a share? I'm glad I didn't, because it's at $431 now. And my yield on cost has increased over that same period from 6.03% all the way up to 7%. And I believe it will keep growing from here because this is a dividend growth stock. It's a world-class company. To summarize some of the lessons from the video today, as you can see on the screen, the key takeaways is I'm talking about why I'm a buy and hold forever dividend investor. I also, though, touched on the concept of dividend yield on cost. I like to invest not only for starting yield, but yield on cost, where I'm able to really pay my bills with dividend cash flow like I'm doing right now with a good chunk of my bills, is I'm able to do that because of yield on cost, which only comes over time by being a buy and hold forever dividend investor. And it only happens based on the third point. I don't just buy any dividend stock, I buy dividend growth stocks. I'm a dividend growth investor. Dividend stocks, they not only offer dividend income to pay the bills, but they do offer capital appreciation. I'm hearing a lot of naysayers these days say that dividend investing, hey, that's just about dividends. They're just returning to you back your capital. No, they offer capital appreciation as well. What's important is quality. I'm not just buying any stock. I buy and hold forever, but I buy quality. What else is important is I accelerate my journey with financial independence, retire early because of buying at discounted prices. All of the three examples today illustrate in different ways tranches that I bought at the right time, at the right values. Even when the stock market is expensive, there's always something on sale, something of quality that's on sale. And so I like to buy at the right price. Patience is required. This is important. I'm talking about tranches today that I bought between the years of 2009, 2013, and 2019. These are older tranches. Patience is required. If you enjoyed the video today, please go ahead and click the like button. It means the world to me. Also, if you enjoyed the video today, a lot of these concepts that I'm covering today, I was inspired because I spent all day today preparing for Blossom Investor Tour Toronto. I'm going to be speaking real soon here. I'm going to include a link in the pinned comment below so you can sign up. And I have my code there, 15% off. I am speaking at Blossom Social's flagship conference in Toronto. And a lot of these concepts and so many more I will be covering in the presentation. I cannot wait. I hope to see you there. If you cannot make Toronto, I will be at Blossom Investor Tour in October in Chicago at the CBOE. Again, pin comment below. Check out my code for 15% off. And if you're not on Blossom Social yet, the app for social media for investors, dividend investors like myself, like so many of you, check out the pinned comment as well. In terms of full disclosure, that's my affiliate link. I am compensated for signups to Blossom. And also in terms of full disclosure, I am long Blossom. I can't wait to see you at these events, and I hope to grab a photo with so many of you. There's going to be a lot of time to network, a lot of time to say hi, a lot of lessons that are going to be shared, and so much good stuff. It is going to be, I believe, the best events ever for dividend stock investors. Before I go, if you did enjoy the video, please also subscribe. It means the world to me. It's the best way you can help me grow my channel here on YouTube. And before I go, in terms of a full disclosure, I am long the three stocks mentioned today. In terms of full disclosure, I am long AbbVie, ticker ABBV. I am long WAL-MART, ticker WMT. I am also long Caterpillar, ticker CAT. Also, I am long Blossom Social. In terms of a friendly disclaimer, Today's video is not investment advice. I'm not a licensed financial advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Before you make any decisions, please consult your licensed financial advisor. Again, this is not financial advice. I'm just sharing my journey for fun and entertainment. Check out the description below for all of my disclosures and disclaimers. And again, a reminder, check out the pinned comment below for all the links to historical videos related to these 3 stocks on my channel and to Blossom Social. Thank you everyone for watching. I appreciate all of you, and I can't wait to see you in the comments section below and in the next dividend stock investing video.